Good afternoon, this is Jonathan Satovsky of Satovsky Asset Management, April 30th, 2018 with a video blog update. And today I want to talk about several high-profile business and financial leaders. Several weeks ago, Amazon's Jeff Bezos had put out his annual letter, which was a must-read by anyone since he impacts virtually all of our lives. One thing I like about customers, I'm going to read a little excerpt. One thing I like about customers is they're divinely discontent. Their expectations are never static. They always go up. It's human nature. We didn't ascend from our hunter-gatherer days by being satisfied. People have a voracious appetite for a better way. In fact, yesterday's wow becomes today's ordinary. I see that cycle of improvement happening at a faster and faster rate than ever before. It may be because customers have such easy access to more information than ever before, in only a few seconds with a couple taps, so on and so forth. So certainly Amazon's Jeff Bezos has raised the bar of expectations for everyone in terms of trying to deliver a client experience that is wow and perpetually wow, and how do you keep upping the wow? But I want to contrast that a little bit to the financial planning and investment world, where if you continue to look for a wow, 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 it could be detrimental to your long-term financial wealth. So we'll use Warren Buffett as the contrast in this example, since this weekend he has his Berkshire Hathaway meeting, which will be very widely publicized. And his well-known quote is, "Benign neglect, bordering on sloth, remains the hallmark of our investment process." Wow. He's thinking about doing things at a very slow, methodical pace on borderline neglect. I mean, it's amazing. That's sort of like raising children. You know, the first one you overdote on, the second one, you know, you're half awake, and the third one you're turning on Sesame Street because you can't really get out of bed. Benign neglect works quite well. But expectations are very important in terms of financial planning and investments. So Bezos goes on in his letter to talk about the handstand, the perfect handstand in yoga. And the idea of getting a teacher to do a perfect handstand. And someone says, well, I should be able to do it in 2 weeks. And the teacher says, no, you actually have to practice every day for 6 months. So I'm going to try the best I can to manage expectations on the investment process, because we're trying to help people plan for the long run, for retirement, for sustainability during their lifespan. And building good discipline habits is very tough with volatile markets and with headlines that, you know, get people very easily deterred. So let's just keep it simple and go back to the wonderful sketch artist, Carl Richards, who says, let's just start with where you are, where do you want to go, and how do we get there? So that's an excellent segue, because we've been reviewing many retirement plans for people and have come across a startling, although probably not surprising, realization that there's in many cases, 50 to 60% participation rates in people even saving for the retirement, which is just mind-boggling. I'm not sure why people aren't putting money away, particularly when they get a match or they get profit-sharing contributions. You know, this is free money for your future self. So teaching delayed gratification is something very important. And delayed gratification, when you think about the best in the investment climate, is also very tough. This is just highlighting the first quarter of 2018, where you see emerging markets had outperformed every other broad asset class in the world. And some people that might be obsessive about the short term would say, oh, okay, I'm going to put all my money in emerging markets because I need to get, you know, I want the best. And, you know, looking back to 2001, you wouldn't have been wrong. You'd say, look, the average quarterly performance for emerging market stocks have been over 3% a quarter, which is fantastic. But let's manage expectations. First, how many people have actually bought and held all their portfolio in emerging markets since 2001? Close to zero. And the discipline of staying diversified is because you don't know what's going to perform best this quarter or this year, and you need to broaden the bases. And why do I say that? Because when we look at the last decade, for example, the best performing has been the US stock market, and emerging markets have only averaged 3% a year 3% a year, not 3% a quarter. They've only averaged 3% a year, despite averaging 3% a quarter since 2001. So why do I remind people of this? Why do I obsess about this concept? Because we just want to help. And with April showers bring May flowers. So whatever we can do to raise the bar and raise the expectations of delivering a better financial planning or investment experience, so we can help the people we care about save more, enjoy their lives, and perhaps click a little less.